Hi everyone. So there is recently I read the book 100 to 1 in Stock Markets by Phelps, and pretty interesting book. It's a good idea to reread. There are so many profound ideas in that, and one such idea I wanted to bring it in this video. It's like the writer compares how to convert $10,000 into $1,000,000 if you have to starting with a capital of $10,000. As a trader, you can make $1,000,000. As a investor, you can cross $1,000,000 mark. There are different ways to make money in the markets, as we all know. There are different ways to heaven. So but which approach is better, or which approach has its advantages and disadvantages, something I wanted to cover in this. Now you can look at the table on the screen. Here is an investor who is starting with $10,000 in his investing account, and there is a trader who is starting with $10,000 in his account. Now in order to get into $1,000,000 mark, the trader will need to double his money on 8 successive purchases. What do I mean? The trader will have to buy and sell 8 times, because trading is short term, right? He has to find a new idea and then he has to sell after it doubles, right? So that's the approach. Now if the trader doubles the money on double his money on 8 successive purchases, right, and the trader will have to make an additional 65% to reach the $1,000,000 mark. You can see in the table, started with $10,000, year 2 it became $17,000, and then it became 28,900. Why not 20,000? Why 17,000? Because if you apply tax, the biggest issue is you apply 30% tax on the trading account after every double. Say $10,000, you apply 30% tax and the frictional cost. Year 2 you will have $17,000. Then the next year, after another double, paying off the tax, you will be remaining with $28,900. Now whereas the investor account, if starts with $10,000, the year 2 it's $20,000, year 3 is $40,000, because the investor is not incurring the tax. It will just keep doubling within the same portfolio. But end of the day, after when you are taking the money out after 9 doubles, right, or 10 doubles, you will have to pay 30% tax, right? We will get to that. But the investor account is becoming in year 4 $80,000. So you look at the disparity there, right? In year 4, year 3, year 4, it starts becoming, the gap becoming widens and widens, and the compounding is happening on higher capital in the investor account. Now leave there. Next is $32,000, then becomes $64,000, whereas a trading account has become 240K, right? This has become 640K. Now the investment account would touch $1,000,000, exactly $1,028,000. Sorry, 1,280K in 8th year. But during the 8th year, the trading account would have just touched 400K, right? Then it needed another double to touch 697K in the 9th year. And whereas the investment account has already touched $2.5 million, and you've noticed that even now the trading account has not reached $1 million. It needs another 65% upside to reach $1 million. Whereas by the time the 10th year, the investment account is already at $4.14 million, right? So that's the idea I'm talking about. Now if you apply tax on the investment account, obviously you have to apply tax, the same amount of tax, right? So if I apply 30% tax, even then the $4.14 million would get you after tax $2.9 million. But what is the trading account standing at after tax? It is at $1 million. So there is an outperformance of 3 times between the trading account and investing account, right? So because the tax plays an important role, it's interest on interest in compounding. Now the other thing is, if you look at it, the investment account would have just found 5 ideas probably and created a portfolio, out of which maybe 3 clicked or 2 clicked. But that is compounding, doubling every 3 years or whatever period. But you just need to find few ideas and stay invested through the course for the 10-year period to double the money every 3 years or 4 years, right? But if you look at a trading portfolio, you need to find at least 7 ideas or 8 ideas probably to double every time, because you're going to double after you double you sell. That is the approach you typically take in trading, right? You might not even double, you might get a 30% upside, 40% upside, you trade in, trade out. So the idea is you need to consistently find ideas to double. Nothing wrong with approach, but the idea is it is very difficult to find continuous trading ideas to keep doubling frequently. But in this case, you just have to find a portfolio and just leave it and let it run and let it double over the same 3-year, 4-year, 2-year period, whatever period you want to double it, right? But the idea is the tax implications. Second is finding frequent ideas is difficult, consistently to trade in, trade out. But some people find it boring to just stay invested in a portfolio of stocks. It's not much adventurous. That's a different topic altogether. But the idea here I'm trying to make from this book, or rather the author is trying to bring out in this book, is it's easier to approach, slightly easier to approach with an investment portfolio and stay through the course. But both approaches are difficult in its own way. Obviously, making money is not easy. If it was a case, then everyone would be rich, right? So this is a difficult game altogether, but I wanted to bring the two approaches and compare it, outweigh which is better. Probably you got an idea, so just wanted to bring it up. Thanks for staying with me. Signing off, Sandeep Anand.